Well, thanks for tuning into this very special conversation, because my mind takes me back to the NDTV Profit conclave, wherein the guest who's joining us on the show today predicted then that at some point of time, FIs will wake up and say that, hey, we missed the India rally. And boy, has that turned to be prophetic. So Tamanna, it's absolute delight to add this just ahead of that India Investment Forum of Morgan Stanley to get in Ridham Desai to talk about all things India, all things the world, and what is it or how is it that he's talking about India to the global investors. Ridham, such a pleasure having you. Thanks for taking the time out.
My pleasure as well, Neeraj. Great to have you on the show as with me. I love to come to your show, as you know. So thank you very much.
Now, the pleasure is entirely ours, Ridham. So, Ridham, tell us, how do you see the world from your viewpoint right now? And what is it that your central messaging could be to the bevy of global investors who are coming in and the corporates who you've gotten in on the conference to talk to them?
Neeraj, it is a difficult situation globally. I think there are many paths that the world can follow, and that will have some impact on India because India is not a small economy. It's a large economy with $800 billion of trade with the world in terms of exports. So there will be some impact. But India, on a relative basis, is like an oasis in a desert. It's looking strikingly better than the world. In fact, a lot better now than last year. The absolute situation is at best uncertain. But as I tell investors, uncertainty is good for buyers, bad for sellers, because uncertainty is when stocks come inexpensive, and that's when you want to buy them. So if you don't buy stocks in uncertain times, you can't make money when things get more certain. So it's a good time to buy stocks. And if you are buying Indian stocks, I think you are even better, because this uncertainty for India is on the periphery. It's not going to hit India's core, but there is uncertainty globally. So that, I think, we'll have to navigate over the next few months.
Ridham, hi, Tamanna here. In terms of the biggest source of uncertainty, the epicenter of uncertainty is right now, I would say, coming in from Washington, where we don't know when we get up every morning whether there are the sanctions, new tariffs, a promise of new tariffs or not. Much like the boy who cried wolf, is the impact of the next announcement on tariffs beginning to blunt in your view, or has the street not anticipated yet what the extent of impact could be from what President Trump keeps saying?
So, I think there are three sources of uncertainty, not just one. The first, of course, is the tariff-related uncertainty, which can produce slowing US and global growth, and that's our base case. There is still some uncertainty around where we will eventually arrive on this, and it will only unfold. So for now, I think the weighted average tariff based on all the announcements is somewhere close to the mid-teens. It's maybe around 14% or so. Now, whether that eventually goes to 18 or comes down to 11, we'll figure, or maybe even lower. And of course, we also have to see what other concomitant impacts happen. So that's one. The second uncertainty, which is a little bit more pronounced in terms of time, it will last longer than the tariff uncertainty, is China's growth. China is slowing down. China is facing significant deflation pressures, significant pricing pressures, and the tendency will be for China to export that weak pricing to the rest of the world, which will hurt Indian exporters in markets where we compete with China. It will also lead to some impact on domestic producers if that Chinese material finds its way into India. So we have to be cognizant of that. And this is not a two-quarter story. I feel tariffs may be done and dusted by the time we arrive in 2026, but the China deflation thing may be much longer. And the third uncertainty is around geopolitics. There are too many things happening in geopolitics which will have some impact on growth. So at best, I think global growth is going to be a lot slower than where we are today or where we've been in the last 12 months. US growth in particular, I think Chinese growth is also likely to be weak. And that's the global backdrop within which India has to function. So, there are many sources of uncertainty, not just the tariff thing.
So, all things considered, and you've laid them out beautifully, Ridham. All things considered, is India relatively insulated from most of these factors of uncertainty? Our big issue is ensuring growth is consistent, corporate earnings are up to par, and consumption doesn't flag.
So see, India is obviously better off on a relative basis. If you look at what we are forecasting in terms of growth, India is measurably better than the rest of the world, and its growth is unlikely to slow down significantly, albeit there is some slowdown that is likely in F26 relative to F25. Or rather, I should say, relative to the fourth quarter of F25, which was bumper. But you see, the thing is that India's exposure is much lower. So, for example, US trade with India is only 2% of India's GDP. So it doesn't really affect us in such a deeper way at the macro level. Of course, there could be micro impacts depending on where our deal arrives with the US, but the macro impact is limited. In fact, if you ask me actually on a multi-quarter basis, I'll be far more worried about China than the US. As I said at the outset, I think the US tariff issue will be behind us in maybe 2 quarters, but the China issue may linger much longer. India's exposure on the external front is largely in services. And there, I think there's a fair bit of strength that we are seeing. I think the services export bit may continue to remain quite robust. It may also slow down. So that is the backdrop. Some exposure for sure. India is not a small economy. It's not a small cap stock, and it's a relatively large. I mean, we know that it's a top economy in the world. It's actually going to be contributing to maybe 20-25% of global growth in the next 12 months. So if you look at it on an incremental basis, India is the reason why global growth is not slipping into recession. So India is important, but yeah, on a relative basis, India looks very good.
That's the way to look at it. India is the reason global growth is not slipping into recession. You made a passing reference. I'm just going to press in on that, on how you saw the corporate earnings for Q4 and for the last financial year as far as India is concerned. On balance, were they better than expected, disappointing, or ways to go?
No, I think we're arriving better than expected. But expectations were pretty suppressed after what happened in terms of growth in the December quarter. I think a lot of earnings were cut. So we got, I think eventually we are better than where expectations were. I think also the slow growth patch that India went through in the second half of 2024, that's behind us. It was triggered by an unusual compression in the fiscal deficit because of one-off factors like election, like rains in August. So we arrived with a very deep compression in the fiscal deficit. Monetary policy had not yet started easing. All those things have reversed in the last few months. The fiscal deficit, recovered, and so government spending has recovered. Therefore, as a consequence, therefore, fiscal deficit has recovered. Monetary policy has eased considerably. So India's domestic situation looks quite strong. Rural consumption looks okay. Hopefully the rains are fine, so there's no overhang from that front. I think urban consumption should recover in the next few months. I would expect some amount of capex, though there will be a little bit of a withholding of capex until the tariff situation settles down. So clearly companies that may have been investing for export markets may just wait for a little while. But overall, I think government capex looks like it'll rise year on year. Consumption will do a whole lot better. Private capex will probably be better than last year, but not ideal where we would ideally want it to be. So in all, I think India should come out quite okay. The only, as I said, the external side is the worrying thing, and maybe export growth slows down, especially of goods. We'll have to watch how it affects services, particularly the likely slowdown in US growth. Some pullback may take place, so that may hurt India's growth in a little bit of a way. But we'll see how much effect actually happens. Ironically, if US is slowing down, American companies' instinct will be to extract more from India because it's cheap to do it here and it protects their earnings. So So I think India's services exports may remain quite resilient, but that may be a slight imponderable into the next 12 months.
Ridham, you've characterized India for a number of quarters now as a low beta market, right? Just wanted to understand, in one of the notes that you had written sometime in May, you had mentioned that the line was something like that said, India will, because India is a low beta market, it will underperform a global bull market. So do you envisage a global bull market in a current growth starved world? Could that happen, and therefore could India underperform? Or that's just a cautionary line in an otherwise bullish scenario?
See, Neeraj, actually, for people who are invested in Indian stocks, that's not a bad outcome, because how do they care whether India outperforms or underperforms?
That's true.
That's more for foreigners to look out for. But yeah, given our outlook on growth, given where global stock valuations are, we are arguing for a very tepid equity market globally. And in that, I think India outperforms. So in our base case, I think India does very well. It remains our top EM in Asia, PAC Japan pick. It's one of our top picks in the world as well, along with say Japan. So India remains the relative, as I said, oasis in the desert in terms of relative performance. But the absolute returns may be relatively muted because India cannot deliver outstanding absolute results if the world equity markets are not cooperating. There's only a limit to how much you can outperform. And so India still, I think, goes up over the next 12 months, but a lot more modestly than we would want it to. And that's largely to do with the fact that the world is, I think, likely to deliver subpar equity returns.
The other aspect of this, Ridham, might be that if indeed the market stays steady and do not have too much of volatility with a downward bias, does that increase the probability of the broader market portfolios doing well? Because as we know, a lot of growth is coming in from beyond the Nifty 50 companies, right? Defense almost largely present outside the Nifty 50 where the growth and the commentary has been strong. Similarly for a clutch of other sectors. Now, you may not have too much of coverage, but a broad brush view, Ridham, of how do you think growth could be or portfolio rewards could be if indeed the market stays steady and don't crack too badly?
Okay, so we'll shift the conversation from fundamentals to market. And over here, I will introduce a little bit of a technical point.
Okay.
So there's an indicator I've been tracking for over 2.5 decades, which is a very simple thing. It plots the average of the correlation of individual stocks with the market. So I take stock A and calculate its correlation with the Nifty, and then we do it for many tens of stocks, and then we take the average of the entire thing, and then we run it back past in time. So when this correlation is rising, it means stocks are largely influenced by what the market is doing, right? Rising correlation. So stocks are tied to what the market is doing. When it is falling, it means that stocks are behaving idiosyncratically. This is a mean reverting variable. So if you look at its 30-year history, it goes like this. Right. So when it hits a peak, that's the time when macro ceases to affect stocks and stocks become, the market becomes a stock pickers market. If you look at the correlation right now, it is at a peak. So the likelihood is in the next 12 to 18 months, we are in a stock pickers market. In a stock pickers market, you become agnostic to market cap, you become agnostic to sectors. You basically focus on individual company fundamentals and stock valuations and make your call. This is a little different from what we have been over the past several months, which is it's been a macro market where mid caps, small caps do very well. And you can make big sector bets because there's a lot of dispersion across sectors. So the best performing sector and the worst performing sector gives you a lot of difference, if you can call that right. So if you look at just purely from a 12-month perspective, the strategy should be now to hug the benchmark, not make big sector calls, and actually make big stock calls. So that's the phase I think the market is entering. So to just come back to your question, it's really not about whether it's a small cap or a mid cap or a large cap. It's about whether the stock has got value in it and it's got growth triggers, and then I think you basically back that. And it can be anywhere in any market cap or sector, and I really don't care. So that is how I frame the market into the next 12 to 18 months.
That's a fascinating way to look at it, Ridham. And for viewers who are tuning in right now and watching this, and they're wondering, okay, stock pickers market, what is the lens or the filters that I need to apply thereon? If I'm not looking at large cap, mid cap, or so on and so forth. Is valuations one of them? Because it depends on who you ask. Either the market is terribly overvalued or there is some value still there.
So see, this question needs to be answered with keeping in mind that equities is the longest duration asset class in the world, and people should make long-term calls in the equity markets. Those who are professional traders, they need to be reminded that amongst the richest people in the stock market, people who made their wealth from the stock market, it's hard to find traders. They usually, just consist of long-term investors. So keep that in mind when I answer this question. The first criteria is always, who are you partnering with? Because when you buy a stock of a company, you are entering into a partnership with an existing set of investors, or you call them promoters or controlling stakeholders or management, whatever term you want to use. Who are you partnering with? Are you comfortable partnering with those people? Would you give those people your capital to manage? So that's the first criteria. Management, promoters, whatever you want to call them, the guys who are running the business for you. The second criteria is, what type of a business are you buying? Usually, it's a little bit, even if the valuations are inexpensive, if you're getting into a sunset industry where the macro drivers are weakening, where business is shrinking, it's very hard for a company to succeed. If you're getting into a business where there's a very stiff competitive landscape, it makes your chances of success lower. It's not impossible to succeed, but chances drop. So that's the second thing, the evaluating the fundamentals. And then third, a little less important, is what price you're paying for it. If you're paying an exorbitant price, then obviously you will have to go through many years of low returns. Usually a good business comes out on tops in time, but you may have to be very, very patient, and you may lose patience, and therefore it is not a good thing to overpay. But that's a judgmental call. It's very hard to know in advance whether you're overpaying or not, because it's so hard to tell what a company will do in time. So that's the last criteria on my list. I would resist to pay too much for a business, but too much is always hard to judge. And I think Charlie Munger told this to Warren Buffett very famously, because Buffett came from the Graham Benjamin classroom where cigarette butt investing was his style. And Munger said, it's okay to buy a good quality business and pay out for it, because in time, a good quality business will deliver returns and you will come out tops. And I think that is the philosophy you follow when you buy individual stocks.
Okay, Ridham, now the other question that we have is around flows, right? And you kind of look at that, you kind of talked about it very at the right time last year when you said that some point of time MFIs will come back. The feeling that one gets is that the yields in the US currently are so high that they kind of compensate maybe to the minds of a few people for the risk that bond investors have to take for deploying money there. So if the risk-free yield out there in the US is so high, would money at the margin move to emerging markets, or would they stay in developed markets like the US?
No, in part, the reason why the yields have gone up is because it seems like at the margin, US capital is looking for diversification. So there is a growing view amongst certain investors that US may struggle to deliver the type of returns that it has in the last 15 years. And there is need to diversify. If you look at the global equity market and just keep India aside for a moment, in the last 15 years, the only call you had to make was buy US stocks. You could ignore everything else on the planet and you would come out very good. And in fact, if you had diversified, then you would have actually not come out so good. So India is the only exception. And India is not available at scale. So for large pools of capital, it didn't matter. So that, I think, is a call that is now being challenged. And when people are making their decisions for the next decade or so, they're not absolutely certain whether the US will continue to deliver that type of performance. So I think in part that's what the yields reflect. They reflect the challenges, that fundamental challenges that America faces, whether it's the fiscal deficit, whether it's the is the possibility that immigration is a lot slower and therefore growth is lower than it has been, and maybe even where we are in terms of stock valuations. India doesn't need access to all that capital. In fact, India doesn't have the ability to even absorb large flows of that size. So I think India will get its fair share of flows in time.
In fact,
we've gone through, yeah.
Sorry, that was going to be my question, that do India valuations therefore stay elevated if indeed global flows were to come in and India's 401k moment, as you know, many have written, kind of stays true, that the Indian domestic retail investor continues to buy, right? So do valuations go up and reach bubble territory, or do you reckon maybe second primary market issuances, block deals, etc., kind of take center stage, or is it that the flows will be measured from the foreign guys because of the valuations?
So Neeraj, first point I will make is that India's valuations are not rich.
Okay.
Let us understand this. Okay, I think when we went into flexible inflation targeting, we eventually dampened inflation walls. India's inflation walls are amongst the lowest in the world. As a consequence, interest rate walls are low in India. And as a result of that, future growth volatility is going to be a lot lower than it has been in the past, both absolute and relative to the world. Equity markets thrive on low growth volatility. As an equity investor, the variable that I have least control on is future growth. If I am told in advance that that growth is not going to move around a lot and is far more predictive, I'm going to pay up for stocks. So I think we should abandon this idea that Indian stocks are expensive. They're not. Adjusted for future growth volatility, Indian stocks are not expensive. Then if you look at Indian yields, bond yields versus equity yields, this is a lot cheaper than India has been in the last 4 years. I mean, India got cheaper than this, stocks, only during COVID. Because remember, Indian 10-year bond yields are 6.2. And if you take the equity multiple at 20 times forward, then it's 5%. Our equity yields are very close to our bond yields, and it's the opposite in the US, where the gap has been widening. In India, the gap has been narrowing in favor of stocks. If you look at Nifty in gold terms, I like to look at that because it's a very good long-term variable. The Nifty is a lot cheaper than it has been over the last 24 months. So stocks on most count, to my mind, are not expensive in India. Now, a lot of the foreign money is what I classify as tourist money. It doesn't actually go into granular details like this and just looks at headline P multiple, which is the worst way in which you can evaluate a stock's value. P is the worst metric to use, but it is very commonly used because it's very easy to use and it's very easy to compare over time, and you can plot really fancy charts and make it very convenient, and therefore it gets abused. And when you look at it on that metric, India looks like, wow, it's expensive, but it's not. And that is why India is doing so well. This market has done well, not only just over the last, say, 24 months, but it's done well over the last 3, 5, 7, 10, 15, 20, 25 years. It has beaten almost every large market on the planet. Because you can't, if you are rich, the stocks are not rich relative to what India's growth has been. And relative to what the return on capital that Indian companies generate, which is the second point I'll make, that Indian companies are very frugal with their balance sheet in large part, and therefore deliver superior return on capital. And that's what equity investors care for, which is return on capital, because that's what return on, making money on stocks is all about, is what return I can generate on my capital. So I think India is okay. I think foreign investors will recognize that and will up their stakes. But the problem here is something different, Neeraj. The problem is who's going to sell to them. And that's where the 401k movement comes. We wrote about this like 10 years ago. and there was total disbelief about what was going to happen with domestic investing. We wrote our last large note around this 6 years ago, and we concluded that this is a maybe multi-decade story. Households have pivoted and will continue to raise their equity holdings. And we're only at 7-8%. We could easily go to 20. So yeah, that bubble situation is possible, but not on a 12-month time frame. I would say on a multi-year basis, we could arrive there. The Nasdaq did go into bubble territory as a consequence of all the buying that US households did over 20 years. So we're still early in this, but yeah, we could get there. It's a possible scenario. So foreigners can only buy if domestics start selling in earnest or corporate issuances begin in India. And then they'll have space to buy. So that's one of those two things have to happen. I think the former is less likely. The latter is more likely. So that's what they're going to get. They're going to get a lot of supply from Indian companies over the next 2, 3, 4 years.
Promoters are definitely going to use some of those opportunities, and we're already seeing signs of that. Just to get a sense ahead of the conference as well, Ridham, on what are the spaces that you're liking as far as the India story is concerned. You've said you don't think that there is an overvaluation. You are positive in the way India stands out versus the rest of the world. Is it a consumption theme you're looking at, capex driven? What are the spaces that you see more value in?
So see, as I said, this is a stock pickers market. So you have to be a bit sector and market cap agnostic. But within that, I think discretionary consumption should do very well. I think lending businesses should do okay, particularly the non-banks and the large private sector banks. The industrials, I think, will be a little bit of a mixed bag. But yeah, there will be some industrials that I think will shine in this because there are certain categories of capex that will be very strong. So I think those are the sectors, largely domestic-facing sectors. I think external sectors may struggle a bit. Within that, I think IT services looks balanced because prices also have reacted to the potential slowdowns. So we'll wait and watch on external side, but I think domestic sectors, I feel far more confident on a 12-month basis.
Sectors, discretionary consumption, those are the large, broad-based themes that Ridham Desai likes. Thank you once more, Ridham, for speaking with us. Always a pleasure.
Thank you, Neeraj. Thank you, Tamanna.
Thank you for joining in. And well, we'll get you more conversations from the Morgan Stanley India Investor Forum during the course of the next 2 or 3 days. But for now, thanks so much for joining in on this conversation.